All right, let's get some pointy-headed analysis here. Sky News Business Editor Ross Greenwood. I say that with love, Ross, because I think you're the biggest brain in the building on these sorts of issues. I want your reaction to this move by the RBA, the sixth increase we've seen since May. What's your take of it? How much more's in store for us poor old mortgage holders? But also, what's been the market reaction?
The market reaction, let's start with that, was astonishing. It was a surprise, there is no doubt. So that reverse of those tax cuts in the UK already saw a very strong day on the markets, and that's because effectively it was seen to be averting something of a financial crisis, especially in the sell-off of government bonds around the world. Then what happens is you suddenly get this sudden, rate rise rather, that's lower than what is expected. 0.25% rather than 0.5%. The market then takes off from about a 2.5% jump for the day to basically the best day in 2 years on the stock market. It was up by 3.75% at the close. This is the rate rise that the RBA has put through from 0.1% to 2.6% currently. It says in its statement it will continue to raise rates into the future. Immediately, the big banks jumped in. So the National Australia Bank and Westpac, straight out of the blocks, then ANZ and Suncorp. We haven't heard from the biggest home lender yet, that is the Commonwealth Bank, but all of them have raised rates and will raise rates by this amount. Just one little thing though, and that is, remember that going back when interest rates were so low, that they were saying to banks, you've got to stress test your customers in case rates rise. We want you to basically test them to 2.5 percentage points higher than they are today. Well, that's where mortgages are. So just having a look at that, the discounted variable rate for Westpac this evening is sitting at 6.17%. Now, a person who previously could get a mortgage rate, a variable rate in the high ones or maybe low 2%, now paying 4 percentage points above it. A typical mortgage, $750,000, means a person is paying around $10,000 extra after tax per year to fund that mortgage. That's where ultimately the stress comes from. And this is the issue where the Reserve Bank is going to be very careful, very delicate in the future, not to tip Australia's economy into recession while it tries to crush the inflation that clearly long term is going to be, if you like, going to hurt Australia's economy.
That is a very sobering point to hit home with my audience tonight, that we are now at the stress point for most mortgage holders on the upside, the best possible relief for them. We're now at the top of that point. Talk to me about this headline in the papers today. It said, remember 1989. That was the year I finished school and you couldn't get a job for love nor money. Mortgage rates were double figures and we're in the middle of the end of the Keating recession. Is that really where we're headed?
Alan Oster, the Chief Economist of the National Australia Bank, I have a great deal of respect for him, and that's always been my grave fear. And that is because it's not the first or second interest rate rise that hurts, it's the last one. And central banks historically have gone much longer with these rate rises than they have to, tipping economies into recession. That's what Alan Oster's talking about. That's always been my grave fear from the time that the Reserve Bank started to raise interest rates to try and quell the inflation.
Oh, I've got to worry about all of this now. I think it's going to get worse. Ross Greenwood, thank you for your time.